The resources used to create this essay include Ryan Selkis' 2024 crypto thesis, Chris Boninsky's Investing in Waves conversation with Bankless, Raoul Pal, his Everything Code and Exponential Age thesis, all the recent On the Brink conversations with Nick Carter and Matthew Walsh, Lynn Alden's 2024 Crypto Analysis and her Broken Money book, Ray Dalio's books and material on the changing world order and economic machine. Catching the Crypto Wave has the ship set sail, understanding economic cycles. This essay is all about cycles. They exist everywhere. Circadian rhythms control your sleep and wake patterns. The Earth's orbit and tilt create seasonal cycles, and those seasonal cycles affect migration, hibernation, and reproduction. Water cycles, carbon and nitrogen cycles, star cycles, cell cycles. We're born, we live, we die. Life is weird, and so are cycles. If you zoom out far enough, cycles create a predictable rhythm, but the closer you get, the harder it is to observe that rhythm. The economy also follows cyclical patterns. Think of it as our world's interconnected systems of production and consumption, i.e. making clothes, developing software, or cutting someone's hair. And on the other side, buying clothes, paying your Spotify subscription, or getting a haircut. A big clusterfuck of complex and interconnected transactions between people, companies, and countries. All economies go through the same process of birth, growth, and decline. There are fluctuations of economic activity between expansion, increasing employment, confidence, production, toward a peak, before a downturn or contraction, unemployment, hardship, recession, where the economy slows or crashes to a low point before commencing recovery. Over the past 100 or so years, the global economy has experienced several major economic cycles. Some of these you'll be familiar with: the Roaring Twenties, the Great Depression, the dot-com bubble, the global financial crisis, and the post-COVID situation we're in now. Most people fail to see the larger economic forces which create these cycles and influence the global economic machine. Ray Dalio has done an incredible job explaining these forces.
How the economic machine works in 30 minutes. The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle.
Most of the famous investors are famous and rich because they understand cycles. Ray Dalio and Bridgewater Associates, Howard Marks and Oaktree Capital, Stanley Druckenmiller and Duquesne Capital. While each of these investors have their own unique approach and differ in their short-term views and predictions, they all land in the same place. The global economy fluctuates between periods of growth and inflation, decline and deflation. It's important to remember that the more you zoom in, the harder it is to predict where we are in the cycle. Things never play out exactly as planned. And most economists and investors love to highlight how good their forecasts were when they get things right, while highlighting how unpredictable the economy is when they get things wrong. New technologies and technological innovations. New technologies have a massive influence on economic cycles, and economic cycles influence new technologies. Example: the Internet was a technology created in response to Cold War nuclear threat. Decades later, the Internet triggered the dot-com boom, major economic expansion before the subsequent recession in the late 90s, early 2000s. In the 1920s, we had mass production of automobiles, highways and roads, commercial radio broadcast and electrical manufacturing. In the 50s and 60s, widespread television and space travel. In the 90s, the Internet, computers and web-based Internet companies. People speculate and invest in new technologies, creating bull cycles and bubbles followed by bust and recession. The speculation is almost always overblown. Mostly everyone overestimates the upside, driving prices up before prices come crashing down. This is new era enthusiasm. Investors overreact to technological innovations. Major stock price run-ups have generally coincided with the emergence of some superficially plausible new era theory in the popular culture that extols the virtues of new technology. Humans also operate in a dance of credit and debt. Massive borrowing, lending, and debt fuels these cycles to dazzling new heights before they come spiraling down. It's like speculation on steroids. Right now, we're transitioning through a time marked by the rapid advancements of new technologies, artificial intelligence and machine learning, blockchains and cryptography, the Internet of Everything and Web3, quantum computing and autonomous robots. Simultaneously, we're also having to deal with rising global tensions and the most fragile and in-debt globally connected economies we've ever had. What does this have to do with crypto? Crypto is both a new asset class, something people can invest in like gold or stocks, and a new set of technologies. When most people hear the term crypto, they are thinking about the investable, speculative cryptocurrencies or coins that sit on top of far more important technological innovations. Bitcoin, Ethereum, and Solana are cryptocurrencies and tokens you can invest in, kind of like stocks, but they're also new technologies with versatile use cases and new applications, supported by entire ecosystems of developers and users. The technological innovations are powered by cryptography and blockchains, or distributed ledger technologies. Just as all waves of technological innovation in the past, people and institutions will invest in these technologies, prices will rise, people will get greedy thinking prices won't ever go down, and then prices will come crashing down again. Over the past decade, the pattern is disturbingly repetitive. This is Bitcoin, the largest and longest-standing cryptocurrency with the highest market cap. There have been three major Bitcoin cycles: a 2013 high to a 2015 low, a 2017 high to a 2018 low, a 2021 high to a 2022 low. Each of these individual cycles were caused by a combination of economic factors, technological developments, and regulatory changes. This cycle has now repeated 3 times, a new high followed by a 70% correction and a higher low. In fact, the number of days between the lows and highs since the 2015 low repeated exactly to the day. Creepy, either an eerily consistent coincidence with cyclical patterns or something much weirder, i.e. the still unknown Bitcoin creator Satoshi was an incredibly foresighted macroeconomist who timed the Bitcoin halving cycle and supply dynamics with the global liquidity debt cycles, or we live in a simulation, probably a combination of all of the above. Anyhow, most people who invest in crypto are completely unaware of the larger patterns. They invest when the price is already well on the way up, thinking it's never going to end, imagining quitting their job and driving off into the sunset in their new Lambo. And then unexpectedly it crashes, and it crashes hard. The log scale over a longer time period shows changes in relative terms, painting a more realistic view of crypto's price over time. Bitcoins, then shitcoins. Within the larger crypto cycle, there are smaller cycles. Traditionally, the price of Bitcoin goes up first, followed by altcoins, which are cryptocurrencies other than Bitcoin, sometimes referred to as shitcoins. Each wave brings a new cohort of investors, most of whom enter through Bitcoin first as the most established, publicized, and easy to access. Once the speculative bull market for Bitcoin is underway, a portion of investor dollars moves to other more speculative cryptocurrencies with a lower market cap, where there is a greater chance of people getting rich. This chart from the recent Pantera 2024 Outlook letter shows this cycle repeating twice. Though it's worth noting, this pattern is far less consistent than the bigger high-to-low chart over the past decade. It's fair to assume that dollars will move from the more established to less established cryptocurrencies in this cycle too. Some investors will choose to move capital from Bitcoin into altcoins as they see Bitcoin move toward the top of the cycle. Some have already done so. Others will invest their entire life savings into a dog meme coin and lose everything. So where are we in the cycle? There is growing interest in the idea that cryptocurrencies and other risk-on assets are correlated loosely with a global liquidity. Risk-on just means riskier, more volatile investments. We won't go into this in too much detail now. All you really need to know is that globally connected economies cycle between periods of high liquidity, more money in the system available to spend and invest, and low liquidity, less money in the system available to spend or invest. When central banks like the Federal Reserve are injecting more money into the economy by lowering interest rates, quantitative easing, or some new made-up tool to print, money flows into assets like cryptocurrencies. So where are we in the cycle? If the cycle repeats itself, then we were likely at the lowest liquidity point back in 2022. And if the cycle repeats, we'll see a new high for global liquidity sometime between now and the end of 2025.
This is our 15-month lead. Because of that global cycle repeating, because of these interest payments, we're in a perfectly cyclical world. This perfectly cyclical world means things become more forecastable. Again, I don't expect perfection, but I expect it to very much follow the path of the past. And that would suggest liquidity is going to keep rising all the way into 2025. And that cyclicality that seems predictable according to the Everything Code means that all assets essentially correlated. It's all part of the same cycle. Some things lead, some things lag. And that means you almost get no diversification in your portfolio. They're all the same, whether you choose emerging markets, commodities, tech, crypto, it's all the business cycle. So you might as well choose the things that go up the most. And those things also happen to be on a risk-adjusted basis better bets too. That gets me really interested. I've gone from running much broader diversified portfolios to an ultra concentrated. Because if this Everything Code is right, this is a fucking gift. It's a gift for all of us. It's the one great macro trade. If that is right, then you should be taking as much risk as you can afford to according to your risk profile. And I'm taking a shit ton for me because I strongly believe in the work that we've done.
How to act on these cycles as a crypto investor. If you're short on time, the best bet is to pay no attention to the short-term price movements and invest consistently in established projects and cryptocurrencies. To illustrate this, if you had invested $10,000 in Bitcoin at the end of 2021, you would have lost about $7,000 by the end of 2022, 70% of your portfolio. Had you paid no attention to the price and invested $100 per week into Bitcoin since the beginning of 2019, you'd now have about $70,000. And if you had done this since 2015, you would indeed be quitting your job and riding off into the sunset in your new Lambo. If you have more time to follow the markets and market cycles, you might consider investing more towards the bottom end of the cycle. Once we move toward the top of the cycle, you can relax until the bottom end of the next cycle before reinvesting. You might also consider taking some profits when you start seeing the market hype towards the top of the cycle, acknowledging that the chances of picking the exact top or bottom of a cycle is virtually impossible. This sounds easy, but it's not. It requires balls of steel. Timeless advice from Warren Buffett. I will tell you how to become rich. Close the doors, be greedy when others are fearful, and fearful when others are greedy. When we are toward the bottom of the cycle, there is an overwhelming feeling of doom, that it's all over. The technology isn't that good. Prices are never going back up. When we are toward the top of the cycle, the opposite is true. Here is some timeless wisdom.
Fuck crypto. You don't need the anxiety. Before you bought the bullshit fantasy coin, your life was good. But then you made some money and became greedy. Now the bullshit coin is fucked. And nobody can tell you when it is going to be unfucked. Even the motherfucker who convinced you to buy the bullshit coin, who told you that it is going to be the next big thing, that motherfucker is nowhere to be found. You are on your own. And all you can do is cry about it in the shower and hope and believe that your bullshit coin will go up in price again so that you can sell it and make some money and buy some more and then get fucked all over again. That is crypto.
What we can be sure of is that cycles will continue to happen in all economies and in crypto. Stay informed. Be flexible to change and position yourself for short-term turbulence because things are going to get bumpy. Adaptation and evolution is key to survival in any cycle. Please subscribe over at theplebcheck.com.